Guys, it's great to have you both. Meghan, we talked last week, and you did say that you thought the time to reduce risk had probably passed. Since then, we've had a couple of 90% up days. You feel just as good about that position?
Yeah, Carl, thanks for having me. I think that this market is one where you have to stay invested. There's a number of headwinds on the horizon, but there's also some potential for rally into the end of the year. If you think about seasonality, if you think about midterm elections as possible catalysts, from an economic standpoint, there are also signs that the inflation data is improving. You were all talking about the ISM services, and I think the ISM services prices paid is probably the most important part of that survey to be paying attention to, because if you look at it, it overlays very nicely with headline CPI and suggests that we could have potentially a 5 handle on CPI by the end of the year. We think it's probably more likely to be slightly higher, but I think that deceleration is in place. And that does set up for the Fed to get to a certain point and then pause and possibly be able to coast this economy to that soft landing.
Right. You're right about some of those fast-moving metrics, Steve, which is why it's kind of curious. This headline from Kashkari a few moments ago, we've seen almost no evidence that inflation is peaking. Where do you think he gets that?
Well, Carl, I think he partially gets it from the anecdotal stuff that the Fed collects. Partially is the Fed tends to be a little late on this stuff. And so I think the markets often get ahead of the Fed, which is both a blessing and a risk from time to time. I think if we get ahead of them in terms of thinking they're going to change prematurely, that's not necessarily a good thing. But in terms of discounting events, it is a fine thing. So where he gets it from is a little tricky to say, but sometimes I think it's more about messaging as anything else.
Meghan, if you're betting that there's going to be some sort of recession, and I realize there's a lot of details about when or what that could look like, how would you recession-proof your portfolio right now, given the conversations and what we do know?
Well, Morgan, we've already had a drawdown that is in line with historically mild recessions. And it's always hard to know, but by all accounts, we do think that if we do have a recession, it's going to be on the milder side. So again, to the intro Carl set up, I think the time to reduce risk has passed. You'd be wanting to look at positioning for the bounce and maybe getting into some of those more beaten down parts of the market. We still like growth over value. Parts of technology have really been beaten down, and they would tend to lead out of this drawdown as well. But I don't think it's the time to be taking huge bets. And actually, we just increased our exposure to fixed income to neutral because of the appeal from rates and what that does in terms of providing attractive optionality from a total return perspective from historically defensive assets. I know bonds have not defended so far this year, but we do think that the next year looks a lot better for investment grade fixed income than the last 9 months.